Great to have you both here. So, Mariann, is it back to the sort of corporate buybacks being the driver of stock market returns here? Do you think this is a positive setup for stocks going into the back half?
First, I have to say I appreciate the fact that Sir Richard opened for me today. Years ago, my father shared the stage with Chuck Yeager, who broke the sound barrier. And today I shared the stage with Sir Richard Branson, so that's pretty cool. So as we talk about what's going to drive retail investors in this market, I do believe they have been emboldened by information that's available on Reddit, success with the meme stocks, whether it was their personal success or their friend's success. I think that that's getting people more interested in the market. And at the same time, there's a lot of people with extra time on their hands and extra cash in their pockets, compliments of the government stimulus payment. So I do think that that is working toward more involvement from that retail side of the market. However, I would caution that we can look for increased volatility in the markets overall, and particularly in these meme type of names.
Okay, so Bryce, Mariann's basically saying, retail investors in the market add to some of the buying power, but also some of the volatility. How would you describe market conditions as we head into the second half?
Well, I think
it's
sorry,
really
Bryce,
positive.
go ahead.
Yes.
I think it's very positive. I think the impact on the retail investor is much greater than the 10% trading volume that's highlighted, because you can also look at the ETFs that are dominated by retail investors, and that has had just tremendous growth. It's up to $6 trillion, up $400 billion year to date. I mean, it's just continuing to grow. The Reddit impact is twofold. Not only is it bringing individuals into the marketplace, you have 10.6 million followers of Reddit, which are predominantly individual investors, but it's scared away all the short sellers. So what's going to drive down the market? So that's another ancillary impact. So I think the individual investor is really making a big impact. You talked about airline industry in the previous segment. I mean, you look at the ETF away, it's up to $380 million. Most of that is individual investors betting on the airline industry coming back. And that's having a big impact on that industry. So we think the setup for stocks going forward is pretty strong, despite the fact that it seems like it's kind of at a heady valuation. Just these retail investors are just piling in. We're seeing cash come off the sidelines, and so it's probably going to continue for a while.
I know some of your particular investments you like, Bryce, include the travel tech. You mentioned Away, the performance there, dry bulk shipping names, that sort of thing. Mariann, your interest kind of goes more into the financials with JP Morgan, Truist, Global Payments in the fintech space. In order for financials to perform well, do interest rates need to go up in the second half of the year?
I think loan growth could drive the values higher simply by that itself. But with the 10-year at 1.44% today, I think the likelihood is it goes closer to 2%, and that will also help them along. And the valuations, and that could be a Reddit theme right there, is look at the 14 times for a JP Morgan or a Truist, maybe closer to 12 times versus 21 for the overall stock market, and yields of the 2.3 to 3.2% range versus 1.3 for the overall market.
Bryce, even though we've seen some significant rotations this year, first into the value trade and then kind of out of the inflation trade and back into the growth one, the market overall has held up really well throughout this entire period. Does that mean it can continue to perform no matter who's in the leadership, or has it kind of pulled forward its gains for the year?
I think it's going to continue. I would buy the dips on any reversal of inflation trades, because as you mentioned, like the ETF dry, I mean, the dry shipping costs are just continuing to skyrocket. It's going to get bigger and bigger of a problem as Europe starts to open up and tries to restock. We see tips as still a very good trade right here, because the accretion rate on the principal of a tip tracks non-seasonally adjusted CPI. That's running at a 10% annualized rate. It was that for June and July. It's probably going to be 5 to 10% the rest of the year. So regardless of what the Fed does, you can actually make a decent amount of return here in a treasury bond. So there are some trades to be done on the inflation front there. Even though inflation expectations are coming down, there will be people talking about it's just temporary. There are still pockets where regardless of what the Fed does, there's just some serious cost pressures.
Shepard Smith here. Thanks for watching CNBC on YouTube.